Hi and welcome to the monthly ETF update, powered by ETF Securities. Very happy to talk about this episode because we've seen a lot of volatility come into the month of October. We've also seen a few bears creep out in that time in different types of asset classes and different types of indexes. I'm joined today with Kanish Chugh. Kanish, welcome back to the show.
Thank you, David.
And Kanish is the co-head of sales for ETF Securities. We came in today because there's been so much change in the last month of October, which we want to focus on here. Kanish, you're probably well positioned to help me comment on that as well. So I'm looking at October, doom and gloom on the headlines. We won't worry about that, but what's actually happening in the market these days, and what kind of, I can only really use the word of selling has happened and what we've seen?
Yes, it's been interesting. Look, when we look at the markets over the month of October, there definitely was, S&P 500 dropped by nearly 10%. A lot of volatility in there, driven by purely largely by the technology sector. So companies like Apple, Facebook, and Amazon, etc. But when we're talking about corrections, and you're talking about, and there's been that sort of, I guess, terms being thrown around a little bit, and a correction in its truest definition is 10% off a high. A bear market is 20% off a high. So, but over what time period is that? We saw the market drop in terms of the US, and now it's since bounced back. So is that truly a correction, or is it just volatility in the market? Is it just sort of a bit of market noise that's occurred within that?
That's a really good point. What is that time frame? We don't know.
No.
The sort of major, there isn't really a definition, is there? It's kind of that what if and when happens. And I think even seeing that, like as of very recently, I don't know when you're watching this video, but as of very recently, the Apple stock recently fell into its own bear market. And that's something which is one of the first few from the trillion-dollar companies to sort of ever hit that from their all-time highs at the moment this year. So it's interesting to see this happening. And I think you can't predict the future past or whatever happens, but it's just good to keep an eye on in terms of when people are saying there's correction.
Yes.
Look ahead of that. See where you can kind of gauge where things are going to go. We
saw that in the ETF market last month. So in the month of October, the largest in terms of sector inflows was actually the Australian equity market. In terms of largest outflow by product, this is interesting, was the IVV, was your S&P 500, had about nearly $30 million of outflows. Now that's obviously indicative of clients saying, well, there's a bit of volatility there. We're not sure, is this a correction? Is this more than that? Let's just take some money off the table and let's put it into cash, or let's put it into the domestic market. Let's put it into things that we're a bit more confident or comfortable with. And that's what we saw with the ETF market in terms of some of the specific plays.
Do you see those sector changes becoming more now of a thematic that these are going to be set? Or is this, in your opinion, do you think this is maybe a blip in what people are used to and it could potentially change? When
we're talking to clients, we have sort of two different sides of it. So you've got clients that say, look, this is just volatility in the market. It actually presents a good buying opportunity. So when you're seeing that drop in, say, something like some of the technology sector, okay, should I look at a pure play tech ETF, whether that's Nestegg from Beta Shares and NDQ, or whether that's the ETF Securities Tech ETF, TECH. So that gives an ability to buy the pure tech exposure. Or it also thinks, okay, well, if there's a bit of volatility in those thematics, and you're still thinking disruption, there is still that longer term play. You're not buying into these products for a short term, 1 week, 2 week, you're buying it into it for the long term. And that's what clients need to consider. It's a long term horizon. So if the idea of disruption, whether that's cybersecurity, whether that's looking at healthcare, biotechnology, battery technology, robotics, automation, that's more of a sort of a 3-5 year play, taking into account, how are environments changing, how are consumer trends changing. And so ETFs now give the ability for clients to take those specific exposures.
Yeah, for sure.
You've got the Robo ETF, which is artificial intelligence. Beta Shares launched a similar in RBOTs, RBTZ earlier this year. ETF Securities launched a battery technology ETF, ACDC, and we launched in November a biotechnology ETF in CURE, so CURE. So again, looking at specific areas and sectors, all it is giving the toolkit for investors to take the ability to, do I want to play that thematic? Do I believe in that? And is this the best time? That's sort of got the opportunity to do so.
So Kanish, can you just give us a bit of an insight of what's been going on in the market?
Yeah, so the ETF market for the month of October, its actual total size decreased by about 3.5%. So it currently sits at about 40.6 billion. But that's interesting because you actually saw net inflows of approximately 910 million. So whilst you actually saw net inflows across the entire product range, you saw the market reduce because of the market volatility last month. Now, where has that actually gone? The largest inflow by sector was Australian equities, followed closely by fixed income in Australian dollars. Now, when you actually break that down by products, the largest outflow by product was the S&P 500 ETF, IVV, from iShares. And in terms of inflows, it was actually the ASX 200, so dominated by Australian equity products, and you also had AAA. So when we think about the sector of fixed income Australian dollar as a sector, they had about $210 million in. About a third of that was actually the BDS's AAA fund.
Going into that, can we get a bit of an idea of the top 5 performers, top and bottom? How's that pan out these days?
So in terms of the best performing ETFs for the month of October, it was actually the BBUS ETF, that had returned 19.7%, and then followed close by the BBOS, which returned 15.6%. And that was actually interesting. You actually saw a commodity ETF. We saw Palladium actually came in third in terms of the third best performer for the month of October. And what was interesting to see though is you got the sort of the inverse sort of leveraged equity ETFs, but then you also had the commodities, so the safe haven assets, and gold was in there as well in GLD, and the Perth Mint product sort of rounded out the top 5 or 6 products that were the best performing.
It's interesting to see these safe haven products, and in previous history when looking at them, they're not always the best performing through a market downturn, but people still see them as those better than equities. It's better than me being in a tech environment right now, maybe not in the future. But having those, looking at oil for just as an example, in October, crude oil dropped into that bear market category as well, and it's one of those real drastic drops that you see in that volatile time of a market. And to see that now coming back into the play of a defensive asset, it does make you think, well, is there still volatility in defenses? In defensive assets, gold is still very much a volatile asset class in itself as well. It
is, but I think when we're thinking about defensives, they're really there to provide some protection in portfolios. So unless a client is very bearish on equity markets, then you would say, well, then taking a large gold allocation makes sense. What I would say is having a small allocation in a portfolio, whether it's 5% or 10%, has actually historically shown having that small allocation just as a bit of insurance within a portfolio can smooth out the volatility within portfolios, especially when you have these periods where you had volatility in October or even earlier this year in February as well. So just having some allocation to some defensive assets, now whether that's physical gold, whether that's cash potentially, or whether even looking at certain of the rules-based strategies, so where they've got some volatility screen. So an example there, we actually looked at IBV, S&P 500 over the month of October dropped 10%. Now we've got a US equity low volatility ETF in ZYUS. So that's got a volatility screen in there, including a yield screen. But that only had a negative drop of about 4% over the month of October. So having that vol screen does help. So do you just look at pure defensive alternative assets like cash or gold or other sort of infrastructure as well? Or do you look at even equity products that have some form of rules-based approach?
Yeah, for sure. And I think just boiling down to it is being diversified within your portfolio and having access to different types of classes is very important, as always, as we always bang on about, because it's the breakup of it all and it's the makeup of it. Kanish, thank you very much for giving us an update on that. I think it's really interesting just to see how markets have played out over the last month of October. Going forward, I'm very interested. I'm going to keep a very, very close eye on what's going to be changing over those coming weeks as well. Kanish, once again, thank you very much for coming in.
No, thank you, David.
And thank you very much for tuning in. This was the ETF Monthly Market Update powered by ETF Securities. Thanks again, and we'll see you in the next one.